Hello, this is Jenny Clark with Solvability, and today's session is about indirect rates for cost plus contracting. This is part of a two-part series because there's so much to talk about with federal contracting when you're dealing with cost plus. So let's get started. First, I'd like to introduce myself if you don't know me. I am calling myself the Oprah of federal contracting. My job is to bring together a community of small businesses that are in federal contracting and provide them access to the information they need to be more successful. If you have questions, you can always go to my website, www.solvability.com. My email is jwclark@solvability.com, or you can call me, area code 256-882-6276. But I'm based in Tampa Bay. I'm actually in Clearwater, Florida. So I've got 5 things I'm going to cover in our session about cost plus contracting. Number 1 is what's different about cost plus contracting? What makes it different from fixed price or time and materials, which are the other traditional methods for contracting? What additional pricing and reporting may be required? When it is cost plus, you are expected to provide additional information. There can be audits, and because of that, you're going to have to develop and maintain more records, and I'll talk about what's required. Number 3, what are some typical billing formats? A cost plus billing format, I can look at it immediately and say, oh, this is cost plus. Want to talk about that, and also want to talk to you to remind you that if you're a subcontractor under a prime, you may have cost plus contracts, but you're going to hide some of that information when you bill up to your prime. Item 4 is how do we settle our provisional and actual indirect rates? I'll be explaining what those are and how to settle those. And the last is how are indirect rates calculated anyway? I'm only going to give you the simplified version. There are a number of different methods out there. Larger companies use more complicated ones, but I'm going to stick to the standard fringe, overhead, and G&A. And so let's get started talking about cost plus contracting, who uses it and why. It's a more advanced contracting method. The reason it's more advanced is because the federal government is signing up to have a contractor provide services when there's a less defined scope of work. If it was a well-defined scope of work, we knew we were going to build a widget, we're going to produce 22, we would know what that would cost. It could be done on a fixed price basis. Cost plus contracts tend to be for program support. Could be a group of activities inside a organization where the contractor is asked to run that group. For example, many years ago when I first started in federal contracting, I was with a Boeing company in Huntsville, Alabama, and we had won a contract at NASA Marshall Space Flight Center where we ran a number of the communications activities for NASA. And there were different groups, and we had contractor employees running those particular things. The reason they did it with contractors is because there was more activity when there was a launch or a mission going on, and they could change around who was working where among the centers. The other part of this tells you how long ago it was. Our contract was to put in telecommunications between the NASA centers to upgrade. It was called the PSCN contract, Program Support Communications Network. And I think we had like $50 million worth of equipment that we expected to buy and install, maintain, and upgrade. But a lot of it was fax machines. And it was also in the days when I don't think we knew the word internet. And I can remember seeing the bills for Sprint and GTE at the time. And they were huge bills, like a monthly bill of $150,000 or something like that. And I would always ask, okay, what is this for and how do we do this? And people would explain to me, okay, that's packet switching. I still don't quite understand what that is, but nonetheless, things have changed since then. Okay, so back to cost plus contracting. There's usually a shared risk when there's a cost plus contract. When you have a fixed price risk, most of the risk is on the contractor because the contractor could win or lose. The government really doesn't care very much about that. They said, this is what we're ordering, you figure it out. Time and material also less risk on the contractor because you're really just getting paid for the hours delivered. And obviously, you need to do a good job. You need to keep up with the hours. You need to match your bill rates. You need to make sure that the personnel that you're providing match the labor category qualifications. But it's more risk probably on the government with T&M. But with the cost plus, what they're really doing is saying, hey, we have activities to run this center. We think, according to the budget we created, that it will cost about this amount of money. And we want you, contractor, to come in and tell us how you would run that activity for us. Cost plus contracts tend to be longer term. They tend to be more defined as far as day-to-day activities and long-term objectives. There's usually more reporting required, but they tend to be program or personnel oriented. And also, by the way, R&D or research and development contracts are typically fixed price, and that would include programs like a Small Business Innovative Research, SBIR. Those are almost always cost plus. They might allow you to have the first or two or three pieces of a SBIR if you don't have an accounting system that can handle it as fixed price or something else. But generally, they want it to be cost reimbursable or cost plus. And those terms are interchangeable. You'll hear them used together all the time, interchangeably. When I say longer term, I usually mean there are 3 years and more. Typically, they will frequently have a base year and option years. So if the contractor doesn't perform well or the services aren't needed, the government could choose not to exercise the option and go out and recompete the contract again. Or if they don't need the service anymore, they could cut it off. So the reason people are interested in cost plus contracts is they're running a fairly large operation. They'll usually have several years of it. They feel like the risk is mostly on the government because as long as they're staying within scope, doing what's asked by the contracting officer and the management they're reporting to, they're going to get reimbursed for their cost. Because of that, there's going to be more reporting requirements, and that's what makes it more involved. So some of the agencies that might use cost plus contracting, NASA is really the one that I see the most, and I think that goes back to my experience from working many years ago under cost plus contracting. And it's funny that these contracts that are cost plus tend to be competed, won by an incumbent. Maybe the next time they don't win it. And what happens is the workforce under that contracting activity usually stays with the contract as it moves forward. So what does that mean? It means that when you bid cost plus contracts, you need to have some insight into who the incumbent is, what they're doing, who their workers are, because you're typically expected to bring on those employees on your payroll. So in a lot of cases, it's really like a 30-day rebadging process when a cost plus contract turns over. There's also a provision that's under most cost plus contracts called the Service Contract Act, and I think they recently changed the name of it. But the reason I wanted to point that out is the Service Contract Act, SCA, has several components, one of which is a wage determination for the area in which it's served, and it's usually a metropolitan area or a region. They'll specify here are the labor categories, and here are the minimum rates that you need to pay those labor categories. And that's called a wage determination. You'll have to look at what the description of the job title is, what the pay rate, and you may have to go and look up what the requirements of that position are, or talk to the contracting officer during the question and answer period if you're uncertain about that. Generally, those are non-exempt positions, meaning that you pay time and a half for overtime. But the other part of the question that's going on right now is discussion about, are we going to change the Fair Labor Standards Act to have more of those positions that used to be non-exempt, used to be exempt, meaning professional services, start falling under this hourly rate Service Contract Act. So the other component of the Service Contract Act is something called a required fringe, and there's a required fringe benefit package in dollar value per hour. So what it means is they'll list inside the wage determination or inside the request for proposal solicitation, it will have, here are the holidays you're expected to offer, and also here is the dollar value of the benefits. And it used to be $4.04. I think it changes every summer. I haven't looked at it lately, but the $4.04 or whatever it is called, you can pay that out in cash. That's called cash in lieu. If you do, you have to show it on the paycheck as a separate line. You need to prove that it's not combined into the rate. So you can't have somebody that's making $10 an hour and you're paying $4.04 in benefits. So you say they make $14.04. That's not the way it has to be done. It has to be done separately. There's always discussion about whether that cash in lieu is also paid on paid absences. Sometimes people will talk about whether it's been paid on overtime. And there tend to be practices related to that contract, and you've got to get clarification on some of those areas. But typically it's 40 hours a week times $4 and $160, something like that a week. And you can give the employees benefits and show that you're paying them at least $4.04 an hour. So this is a big issue because it's a competitive issue. If you pay them out in cash, that's going to be one cost. If you do it in benefits, you have to be able to prove on every single employee, not average, every single employee, that they're earning that wage determination per hour. The other thing that's so important about this is because of the Affordable Care Act and some of the other changes that have come along that are still not settled, there's discussion about whether you should actually be paying the $4.04 in a different method. And most companies would prefer to pay it in benefits because they can put it under a cafeteria plan. If it's under a cafeteria plan, the company can save Social Security and Medicare taxes under the cafeteria plan, which is a Section 125 plan. The other thing about it is that there are companies that are saying, well, we're just going to put it in a 401k plan because we need to do that. And when that happens, if you had an employee that had been working on that contract for 10 years and they were making $10 an hour plus the $4 premium, so they were making $14 an hour, and you say you're the new contractor and you come in and say, well, I'm going to give you the same pay. Their first paycheck comes along and they get in the $10 an hour, but you're throwing the $4 an hour to 401k. That employee has just had a humongous pay cut. So these are issues that are coming up. You need to do some research if you're doing cost plus contracting. You need to really talk to some people that have specialization in this, find out what's been bid on the previous contract, what the terms have been, and what you need to do to be competitive on it, plus comply with the Affordable Care Act. And you can see there could be implications depending on what size your company is. Are you 50 employees? Are you 100 employees overall? Where are you? There also can be collective bargaining agreements, unions, that you would have to comply with under cost plus contracts, and that's not that unusual. And usually all of that would be well defined in the contract, and you would get a copy of the collective bargaining agreement. And, I've had a lot of people that tell me the easiest thing to do is to be able to follow those rules. But usually if there is a collective bargaining agreement, there's some very detailed pay situations that you have to spend time figuring out. So besides NASA, some of the other agencies that might do cost plus contracts, the Missile Defense Agency, any R&D work, usually with Department of Defense, Army Research Lab, Air Force Research Lab, any of that could have cost plus contracting. So make sure that if you are going off to cost plus contracting, that you've done some research, that you know what your systems are going to cost, that you have a plan to put it in place, because in my opinion, you really can't run cost plus contracts using QuickBooks. The other thing with cost plus contracting is you'll have to submit an annual incurred cost submission. DCAA.mil has information. If you go there, there's a section on the drop-down menu And what you want to do is look for two documents. One's called Information for Contractors. That's a 135-page document that explains here's the accounting system requirements and a lot of other things. So you could skim the entire thing, but spend a fair amount of time on the accounting system requirements and the incurred cost submission section. Then you can download the incurred cost electronically. It's called the ICE. That is the model for the incurred cost submission. I'm going to talk about that a little bit more here in just a few minutes. The other thing that you need to understand is maybe you're not the prime contractor, you're a subcontractor. You're going to receive flow downs from your prime, and frequently those flow downs would require that you complete an incurred cost submission if you're a sub, because typically they're going to want you to have your contract set up cost plus as well. Now that's a commercial contract between the prime and the sub. Maybe you won't do that, but if you want to play in this market, you want to invest in systems so you can do cost plus contracting. So you can get to the point where you can prime those yourself. Okay, so let's talk about what you have to have. You have to have more complex pricing, more complex systems. Here's why. You have to be able to show your indirect rate calculations. Cost plus contracting means they're going to reimburse you for your cost plus your indirect cost plus a fee. And so the way that works is you would have payroll costs, you'd have the direct labor of the employees that are charging the contract. You could always trace that back to your payroll system, to your timesheets, and show exactly what people were paid. That's the first part of the cost. But then you have to be able to show the percentages that would apply for their fringe benefits, for any overhead, which is your technical support of your direct workforce, any G&A or corporate expense, general administrative. And you need to show those calculations. It's called indirect rates, and typically that would be based on your income statement. I should be able to take your income statement or the details underneath your income statement and calculate using a standardized method. There's usually some common methods to do it. There's several common methods, but you would express your cost as a percentage of direct labor and other costs. You need to show history plus your projections. Small businesses, when they first start out, they might not make money the first couple of years. They might not have a fringe benefit package. They might not have much overhead. Their G&A or general administrative rate might be quite high because they're spending all their money on bid and proposals. They don't quite have the contract base. That's historical. And then there could be projections. The reason I wanted to bring that up is that you're allowed, as you're bidding for cost plus contracts, to show what you think your projected rates are going to be. You don't have to use your historical rates necessarily to do that, although you should have a basis, you should have a methodology, you should have comparative. And learning how to track and manage your indirect rates, keep everything in balance, is a very critical part of your growth as a federal contractor. You frequently have to show several years of projections in a proposal. And what I mean, I've seen them where they'll ask you for 10 years of indirect rates. Well, Lockheed and the Boeing Company, they've got people that do nothing but update their rates all day long, entire departments of people. And usually they'll have something called forward pricing rates that at a large company, they would update once a quarter. And it's very standardized, very well documented. And it's even backed up by something called Cost Accounting Standards, or CAS, disclosure statements. And disclosure statements are long written documents that explain this is how we calculate our fringe benefit costs. This is how our employees receive compensation for personal time off or holiday or leave. As a small business, you don't have a disclosure statement. You're not CAS covered. You should be compliant. You should understand a little bit about what it is, but you're really going to be complying with the Federal Acquisition Regulation and DCA requirements. So whenever I see one of these projections that says show 5 years worth of future projections, that is so hard to do, because as a small business, To be able to see 98 days out is really good. And what we typically would do would be do a detailed projection for the current year and the next year, and then the following year, the third, fourth, and fifth. It's usually just taking the same indirect rates and creating a budget that keeps those stable. I also do recommend that you try to figure out what your normal going rate for indirect rates are going to be and then manage to that. And here's why. When you're bidding these contracts and they're 3 and 4 years out, if your indirect rates have increased substantially by the time the fourth year comes around, you could overrun the contract. The other reason you need to manage those indirect rates is most companies have a mix of fixed price, time and material, and cost plus work. Well, you could say, if we underrun our indirect rates, that means we're going to show more profit on our time and material and our fixed price contracts. Totally true. Profit is good. But what'll happen is if you underrun your indirect rates on cost plus, you'll end up owing the government back money. And you really don't want to be in the situation where you write them a check. You want to manage and understand the indirect rates. And this takes some time and some effort and some energy and learning to really be able to understand and manage. And is advanced cost accounting where experience really counts. The last thing I wanted to mention is you don't want to share your indirect rates with your prime contractors or teammates. Typically in the solicitation, as you're submitting your proposals, they might be sealed bids. They could be different ways that it's done, the sealed packages. And there usually is a checkbox that you would check that says DCA can come check my rates, but I'm not going to show it to my team rates. You don't want to show them your rates then, because you're going to be a teammate and a competitor with them on other projects. They don't see your rates either. So you always want to guard that. They may ask you, and sometimes I can look at people's rates or what their their bid rate is versus their base labor, and have a pretty good idea of what their costs are. But you don't want to make it easy for anybody. The other thing is you will have to have your accounting system ready. And with that, what we talk about is DCAA, Defense Contract Audit Agency, has a document called the SF-1408 Pre-Award Survey. You as a small contractor cannot request it. Your prime cannot request it on your behalf. Your prime cannot request an audit. Only a contracting officer can make a request for DCAA to do any audits. And DCAA is really like the CPA firm of the government, and they only work on things that they're asked to be involved in. So you can actually go to dcaa.mil, and there's a button up there that says request an audit, and you could click on that and think that you could request an audit, but it's only for contracting officers, so don't get your hopes up with that. The other thing is when you have an accounting system and set it up, DCAA might come and do an audit, but only if they have a reason to. And I just mentioned that a minute ago. What I've seen as practices lately is if companies get on C-Port-E, DCMA will send them information that looks an awful lot like a DCAA audit, and they get involved and help you out with that. That's a good way to get your accounting system reviewed. Another way that would be that when you're in the RFP stage, in the documentation of the solicitation, it will typically say, must have an approved accounting system. Well, what does that mean? By whom? And you should contact the contracting officer during the question period and talk to them about that and say, hey, we've never had a DCAA audit. How do we get that done? And for you to be able to adequately bid on that, you would expect to have the contracting officer should order a DCA audit. And I've even seen in certain organizations, they're now actually, when a big cost plus contract's coming on, they're routinely going and having the audits of the subs done. This is a huge issue because large primes, or primes in general, are responsible for their subs, and there's certain pricing analysis they're supposed to do, but they don't have access to your books and record. So it's going to be a big, big issue. Okay, so let's talk some more about cost plus contracting as far as positive and negatives. The positives are cost plus is usually longer term. You're reimbursed for all allowable costs. Allowable costs are the costs that are incurred in performance of the contract, and they would exclude something called unallowable cost, which you can spend and they are tax deductible. Unallowable costs are interest expense, entertainment, alcohol, contributions, sponsorship, fees and penalties, fines. There's a number of others, and they're actually defined. If you need to look them up, I'm having a brain fart. I can't remember what it's called. I'll think of it here in a minute. But anyway, it's FAR 31, and I think it's 205 is the list of unallowable costs. But it's easy enough to find if you just Google unallowable cost for federal contracts. That should help you find it. Cost plus contracting usually carries a 6 to 8% fee, so that's good money in the federal contracting world because it's steady. And it's usually a way that you can, kind of count on that profit. You've got a sustainable contract. You've got a regular revenue stream. It can be a large chunk of your revenue. And so it gives stability to your company. So that's really nice. But you can overrun a cost plus contracting because you could overrun your cost. You could spend more than you're supposed to. You've got to really pay a lot of attention about that because they're basically giving you a budget and say manage within this, and you need to be communicating with your contracting officer and your customer to make sure you're doing what's needed. So let's talk about the negatives. It's more complex billing. Because the government is expecting you to do this, they're now making you report more. When I was first working on cost plus contracts, it was great because even though internally we might keep track of, 40 different activities or tasks that the program manager wanted to keep up with, we just had one bill at the end of the month for $1 million that we'd send and get it approved and get paid on that. Well, the government doesn't have the resources anymore to do the accounting they need to, especially if they're really managing budget or activity that they're supporting other organizations and they've got money transferred in. Maybe the Army's running the contract, but Air Force is ordering some programs off of it. And just let's put it under yours and we'll just do some transfers. Well, because of that, they're passing the requirement for more complex billing and more complex cost tracking down to the contractor. So prime contractors that are doing a lot of cost plus, there are a number of them that have gotten really good at it, and they'll actually have really integrated accounting systems between the prime contractor and the subs. And sometimes they'll say, we want you on our timesheet system, or we want you to use the exact same software so we can have the same exports, so we can easily consolidate the timesheet data on a weekly basis so we know exactly where we are every single week. And even though we're only going to bill once a month. So you can see that's a lot more. Indirect rate management is critical. If you don't manage your indirect rates, you're going to overrun the contract or underrun the contract. Either one of those is going to cost you money and it's going to affect your cash flow. So you really want to understand what that is. And you do have to complete the incurred cost submission. So let's talk about contract value and funding. With cost plus contracts, instead of just saying you'll get a contract for $3 million, you'll get a contract that might be valued at $3 million, but there'll be a component of it that is cost and then a separate component for the fee. And you have to track those separately. There will typically be contract line items or CLINs, and those would have been identified as you're preparing the proposal. So the flow should follow from here's what the RFP was, here's what the proposal is, here's what turned into a contract, and there should be continuity in that. There could be task orders or delivery orders. It depends on the kind of contract and what agencies are being ordered. And there are other things besides task orders or delivery orders. But on these large contracts, some task orders could be huge, $6 million, and other ones could be $100,000. The customer may demand additional reporting, and you may not always know that until you're trying to get your first invoice approved. And then the contracting officer, whoever has to approve it, will keep rejecting your invoice and say, where's my report? Where's my report? And you'll think, what report? I didn't know I had to produce that report. It wasn't part of the documentation, but you know what? They're not going to approve your invoice until you approve it. So it's really a catch. You need to Watch out for that. Pay attention and find that out as early as possible in your discussions with the customer. Document it. What did you talk about? When did you talk about it? What do you have to do to prepare? Because these are definitely big hidden areas of risk. For example, in working with a contract that was for the motor pools at West Point, the question was, did we have to report by I think it was like site level or something like that. And obviously, when we're setting up an accounting system, if you have to track by that additional field, that would be a big extra work. And the question is, how do you set it up when you don't know what that list looks like? So just keep that in mind. Typically, there's an initial contract with a ceiling established, and the ceiling is the potential, not the authorized. You're only authorized by a funding modification. That's the only one that gives you the money. And for example, that authorization, the funding modification, they'll call it a funding mod, might be broken into $100,000 worth of cost. If I've got 6% fee, that's $6,000. So the contract value would be $106,000. So there's a concept of contract value and another concept of contract funding. Value is theoretical, and it might be this is what we expect to spend on this task order over year one, and they might not exercise option year two, so you don't really count that yet. And so I might have the base year is $5 million with a $300,000 fee, so it's a $5.3 million contract of value, theoretical. But my funding mod, I might be incrementally funded, which it usually is, because the government's always trying to figure out where do we get the money. We haven't received the authorization from headquarters to put the money on the contract. Lots of delays, lots of questions, sequestration, funding risk, all kinds of stuff. So I might have a funding mod that actually authorizes the expenditure of money, and that might be $1 million with $60,000 in fee. So my authorization for funding is $1,060,000. So there's a limitation of funds clause in these contracts, and there's usually an allowable cost and payment clause. So you need to read your contract and understand that. You really want to understand a cost plus contract before you get into it, but it is a way that a lot of companies grow. So let's talk about cost plus contracting in terms of what you're getting reimbursed for. What are the components? You're typically reimbursed for your direct labor, plus your direct non-labor, and sometimes they'll call this generally other direct costs, but typically it's direct travel, direct materials, direct subcontracts, sometimes direct consultants, and sometimes there'll just be another general thing called other direct costs, which would be kind of incidental things that they've authorized you to spend for. There's usually an approval process for your travel, your materials, for any of that expenditure, because what you're doing is fulfilling orders from your government customers. They say, we need this done. You're issuing the purchase orders, but there's usually an authorization process way down at that lower level that your government customer approves it before you take action. The same thing's true on travel. If they ask you to send 16 people to New Mexico, there's going to be a document that authorizes that authorizes you to go, and you need to be able to track to those authorization documents inside your accounting system. You'll apply indirect rates. It could be fringe, overhead, and G&A. Sometimes fringe is rolled into overhead. Different agencies do it different ways, and then there'll be a fee percentage. You'll have indirect rates, and to me, there's 3 or 4 versions. There's actually like 5 or 6 for me of indirect rates. Your provisional billing rates are what you estimate you'll spend for fringe, overhead, and G&A over the course of the year. That's provisional. You'll write a letter to DCAA and say, here are my provisional billing rates. You're supposed to get approval from DCAA. You typically proceed with those provisional rates, and they should send you a letter acknowledging that they received your provisional rates. Now, sometimes they'll come out and do an audit and say, this is what we want you to do on indirect rates. And I have seen situations where DCAA has said, since you don't have a good method for estimating your DCAA, your indirect rates in the current year, we're going to fall back to what your indirect rates were for last year. I don't really like that. And I want you as companies to avoid that. You should have a system in place, because maybe last year my indirect rates were a lot lower because I didn't have a benefit program. I didn't have people that were doing as much recruiting as I do now. So if they took my last year indirect rates, my actuals this year are higher. I'm not getting reimbursed at the appropriate rate, and I'm going to have to wait for a while to get paid on costs that I'm actually incurring. Severe impact on cash flow. And this is something that I like to talk to people about all the time. So there's more information we need to cover on that. At the end of the fiscal year, your fiscal year, not government fiscal year, but for most small businesses, their fiscal year ends in December 31st each year. You would say, here are what my actual rates are. You would go through your normal year-end closing process, and typically you'd want to have your indirect rates for that year-end figured out by the end of January. Now, obviously, sometimes your CPA will have adjustments. You'll have to decide whether those adjustments are adjustments that are part of your management reporting and what you get, because sometimes the adjustments they're doing are just for taxes. You've got your management reporting versus your tax reporting. Those are two different things. The main things that a CPA firm would adjust for companies would be your depreciation calculations, but again, as your systems are advanced, you should be able to do all that yourself and really know what those rates are, so that the DCA, the audit firm, I didn't say that right, your CPA firm, if they are doing working with you, you're pretty much saying, this is what we present. Do you agree? And you might get some input back on them. But you should know the kind of adjustments that the CPA firm is going to do, so you go ahead and make it on your books. And they might change it around a little bit, but not a lot. So those are called actual unaudited rates. And then when DCAA does an audit, and they'll approve your final rates, but you have to submit an incurred cost submission. They have to receive it, say it's acceptable, and 3 to 5 years later, they'll come do the audit. So that's a big deal. So the cost plus contracting requires an incurred cost submission. There's an allowable cost and payment clause that states that you will submit it. It's FAR 52216-7. And it's also called an ICE. You can go to dcaa.mil to find it. A large, complex set of spreadsheets proving your allowable cost and indirect rates, and needs to be reconciled to your billing and all your costs across your entire company. I think there's 26 or so spreadsheets, so it's fairly complex. It's due 6 months after the close of your fiscal year. It is subject to audit. For the most part, they'll come out and do an audit on the first time that you submit it, and then for a small business, they're doing like a lottery system, and maybe you get picked and maybe you don't. They may just send you a letter that says, we're approving those rates without performing an audit. These are acceptable, something like that. You really never know. You have no control over that. You don't know when they're going to come, when they're not. And it's usually about 5 years behind. I've got a small contractor that I'd worked with in New Mexico, and they were headquartered in Texas. And it went back and forth, and she only had like a small business innovative research. They had under $1 million in revenue. And I can remember having to prepare the incurred cost submission for her and with her, and it was a big expense, not a big risk to the government, but we had all kinds of meetings with DCAA to find out whether it was which branch was gonna do the audit, who was gonna do the audit. The audit would be scheduled, then canceled, and it was crazy. And that's kind of the way it works. So they are typically about 5 years behind. They've spent a lot of time and effort to catch up over the last several years because they've gotten so much heat about it. And the main thing is they're trying to focus more on higher risk. So most of the time, if there's a way they could classify a small business as lower risk, they want to do that. And you as a small business can make it easy for them by having good accounting systems and good procedures and written documentation and understanding all the math. But the other thing about an incurred cost submission is, to me, it's a minimum of 40 hours to complete. And that's if you know what you're doing. What I typically do is work with companies to complete the first one, and then kind of do hand-holding for subsequent ones to have some review time on it. So Just wanted to give you an example of what the ICE, the incurred cost electronically, looks like. It's this massive spreadsheet, and the one that I think is the most complicated is it's called Schedule I. And for these cost plus contracts, you have to list all your cost plus contracts, and there's an underlying schedule that says here's my direct cost, here's my fringe, overhead, and G&A, and you have to tie it to your billing and show how much you're under or over billing. When you do that, if you have overbilled, you should issue a check to the government to settle that up. You're supposed to settle every year separately. You can't say, well, let's just let it roll. We underran this year. We'll overrun next year, make up for it. That's not the way it works. You are supposed to settle that up every year. And sometimes you'll have a prime contract that says, oh, don't worry about it. It's a 5-year contract. We'll make it up next time. Please don't listen to that. You're running a lot of funding risk when you do that, because they might not have funding on the contract when you get out to the point where you're trying to settle that up. So do not take that risk. I just wanted to show you the checklist for the ICE. There's Schedule A through O. So there's a summary of indirect rates. There's a detail page for your G&A, your overhead, and your fringe. You could have intermediate pools, and those would be things like a facility service center. You have to reconcile your general ledger cost to your job cost ledger. There's a summary of claim cost that pretty much takes every single contract you've got and says this is how much we had on direct labor, direct travel, direct subs, and how the calculations of applied indirects go with that. There's a Schedule K for your time and material contracts where you have to show here's the labor category, here's the hours, and here's the billing rate, and here's the cumulative billed. You need to be able to trace that back to your time cards. That also means that when you're completing time cards, the time card should show the labor category. You shouldn't have somebody in the billing department say, well, I think Joe was a program management and Steve was a logistics analyst. There should be a drop down on their timesheet that codes it that way up front. There's a reconciliation of labor to payroll. It's called Schedule L. That's probably the most wicked of all schedules. You have to show that the timesheets, hours, and costs that you ran through a process called labor distribution agree to your quarterly payroll tax reports, which are called 941. And the 941 reports, you typically would take your Medicare wages and include in that, adjust it for your cafeteria plan. And then you also have to do some adjustments for your accrual because you have wages from, say, December 2016 that were paid in 2017. And you could also have the same situation in the previous year that you have to deduct the wages that were earned in 2015 but paid in 2016. There's a management letter, there's certifications, there's a supplemental thing about the 5 highest compensated executives. There's what's your contract closeout. You have to list cost plus contracts where your company is a subcontractor. They update this from time to time. It's pretty standard. It's been this way for a number of years, but it's definitely something you want to understand, get some expertise on as you're doing the first time, because if you get it wrong, you're leaving money on the table. I have an example of that right now. I'm working with a company that does a lot of Corps of Engineer type work, and they do Department of Transportation type work. And they had their CPA firm prepare an overhead audit, and it was for Department of Transportation. Well, Department of Transportation took some of their fringe benefits and said, we're not paying for that, which that's their rule. It's a state Department of Transportation. But they had costs that were allowable under cost plus contracting, and they needed to recover it because otherwise they would have owed that money back. So you can't just say, well, my CPA firm prepared this. We need to have something that's prepared under the rules for DCAA compliance. Overhead is not the same thing under all scenarios. And that's also true even with federal contracting. The reporting for National Institute of Health is a lot different than the one for Department of Energy or Department of Defense. And really, right now, DCAA is no longer doing NASA audits. So there's a lot going on in this whole area. Well, anyway, I think I've told you all I know for today about cost plus contracting. I hope I was able to give you some information that's useful to you. There's another podcast coming behind this that includes more information about the specifics for cost plus contracting. Again, if you'd like to contact me, the best way to find me is my website, and that's solvability.com. And if you have any interest in finding out more, we've got a number of links on the website to show you how to calculate wrap rates. And we're also introducing a program to help people figure out where they are in their government contracting cost accounting maturity. So if you'd like more information on those programs and how we can help you, please reach out to me. You can always find me on LinkedIn as well. Thanks so much for listening.